Despite the disappointing August US jobs data released on 3rd September 2021, the rupee registered a sharp rebound in the previous week from the high of 72.9175 on 3rd September to the intraday low of 73.85 registered on Friday last week. The rebound in the rupee was mainly on account of huge import recovering at firmer spot rupee exchange rate level combined with the lower forward dollar premia prevailing up to 6-month maturities. The absence of exporter selling also helped the rupee to rebound. Going forward, we expect the rupee to hover in the range between 73 to 74 level with bias on the upside due to pipeline dollar inflows expected in the coming weeks. Even though India's exports jumped 45% to USD 33.14 billion in August as against USD 22.83 billion in the same month last year, the trade gap has widened to USD 13.87 billion in August 2021. Exports in August have declined from an average of over USD 35 billion registered in the last 3 months period, suggesting the need to maintain competitive exchange rate to achieve the export target of USD 400 billion set by the government for the current fiscal. The market participants expect the RBI to actively intervene in the market to halt any sharp depreciation in the rupee beyond the 73 level on a sustainable basis. It is interesting to note over the last 2 years, forex reserves have grown by USD 204 billion. The sizable increase in forex reserves combined with the dilution of forward dollar purchase position of RBI into the spot reserves position over a period of time would add comfort to the market participants to relieve from any worries on the possibility of a sharp depreciation beyond the 75 level before the end of March 2022. As the rupee had appreciated by close to 1.5% in a short time span of 1 week, the expected rebound from the 73.00 base has happened. The lower forward dollar premia up to end December 2021 maturities combined with the firmer rupee exchange rate encouraged the importers to hedge their import payables, which led to a quick rebound in the rupee exchange rate from the high of 72.9175 registered on 1st September 2021. When the entire market was expecting the rupee to break the 73 resistance, the reaction from the market was on the other side. The dollar buying by foreign banks and huge dollar purchases by oil companies combined with import recovering in various maturities up to the end of December 2021 led the rupee to trade on a weaker note. The Reserve Bank of Australia became the first central bank in the developed economy to moderate its monetary stimulus program and scale back its pandemic era asset purchases. The market expects more central banks may follow suit over a period of time, which would diminish the risk appetite of investors. We expect the US Federal Reserve to hold off on talks of asset tapering at its September meeting and may be seen pulling back its asset purchases latest by the early period in the first quarter of 2022. The delay in announcing the tapering would lead to the riskier currencies to shine against the dollar. Even though we are seeing a strong rebound in the rupee from the high of 72.9175 on 1st September to the intraday low of 73.85 on Friday, the market expects the rupee to surrender its gains over a period of time for a test of 73.00 stiff resistance yet again, backed by the strong dollar inflows expected in the coming weeks. Hence, the exporters and importers have potential opportunities to hedge their revenue exposures at the appropriate level to benefit from higher export realization and minimization of exchange rate risk on import payables.